making money is a good thing, and we need to do it to provide for our families, to support our society. And we've often been told that you also have to pay taxes, right? Death and taxes are the two guarantees in life. And I think we have focused too much on this need, like you have to pay taxes, and haven't focused enough on the beauty that the tax code can offer in the form of tax savings. And a lot of that is done through the power of real estate.
Hi, Adam Gower here, founder of gowercrowd.com and host of the Real Estate Reality Show at youtube.com/gowercrowd and on all major podcast channels everywhere. My guest today is Chris McCormack, who is a CPA, an accountant at Better Books Accounting. And he is actually the first conversation that I have had examining the tax benefits of commercial real estate, of investing in commercial real estate, both as a sponsor and also as a passive investor. This series is going to cover all of the major aspects of the tax benefits. I've always kind of shied away from the tax benefits, only because the tax code seems overwhelmingly complicated to me, and I've always relied on others to advise me. And I have discovered that not everybody who it seems is an expert is necessarily an expert. So that's why I'm putting this series together, to provide you with some insights from some of the experts out there who have deep experience in commercial real estate, both through their clients, through their own activities. And Chris McCormack is very high up on that list. If you want to know more about Chris and how to reach him, just go to the podcast page at gowercrowd.com, where you will find links to his company and also to his LinkedIn profile, as well as a very big red subscribe button somewhere on the page there to the Gower Crowd newsletter. If you've not already subscribed, do please sign up for that. It's totally free. It goes out once a week. You will be joining, as you will see when you click that subscribe button, quite an illustrious group of investors and professionals who are subscribed. And we cover the prior week's news, the headlines in commercial real estate, syndication, and investment finance every week, as well as providing educational content, both free and also sometimes premium options as well. All right, that's it. So today is our first discussion about the tax benefits, a not boring topic, actually, in fact, extremely interesting, as you'll find out. Chris McCormack absolutely loves it. So let's turn it over to him right now. Chris McCormack, CPA at Better Books Accounting. Here he is. Chris, thanks so much for joining me. I'm really grateful to you. You, in our little chat just now, you used the term, and I was talking about about accountants that don't seem to have knowledge about commercial real estate, and how you met Yona Weiss, which is how I met you.
Yep.
And you used the term before I started, or when I started this journey.
Yes.
Why don't you tell me what journey
Oh, man.
did you start when you met Yona? Tell me more about that.
Yeah, of course. No, Adam, thank you for inviting me on. Excited to jump in here and offer some insights to your listeners and just connect more. But yeah, a little bit about me and this journey. As you mentioned, I own and operate a tax planning firm where we focus solely on the real estate investor and those who are overwhelmed or frustrated or concerned about the tax code and how it influences their investing strategy, their investing opportunity, maybe their investing burden. Because yeah, we know that there's a lot to consider when it comes to taxes, and especially when you're in the real estate space. But before that, I was working at a Big Four accounting firm, PwC, out in Boston, working with high income businesses, people in the financial services space, as well as people in the real estate space, people in the insurance and banking industry. And I quickly realized that some of the strategies, some of the things that they were doing with their money was something that just about anybody could do. And so I took that and offered it to more of the smaller fish in this big economic pond, and started to build this firm up. So ever since then, we've been focusing on the real estate investor, the people who are looking to save more and keep more money in their accounts so they can build a portfolio and a legacy and start to make an impact in their small circle or large circle, wherever it is. So yeah, it's been about 3 years that we've been doing this. I love working with investors. I understand that the tax code is not something that everybody likes to research or get behind, and so that's where we come in and fill the gap. So I'm excited to be here, Adam, and talk with you today.
So one of the I've actually found that one of the best ways to learn is actually to communicate with somebody who knows absolutely nothing, because that is, you got to start from the ground up. And I will tell you that, just anecdotally, when I was in Japan, my brain has limited capacity. When I was learning to speak Japanese, I avoided learning all the words for the different types of fish. There are thousands of them. I just went into restaurants and said, give me what's the freshest today, right? It was just too much for me to comprehend. I didn't want, it was going to clutter up my brain. I've always had the same reaction to the tax code. Oh my goodness.
Yes.
So you are talking to somebody who has avoided learning about tax. So I'm going to betray my total ignorance. And I'm quite a bright guy. I mean, all modesty aside.
Yeah.
I'm going to ask you some really dumb questions, but let's start at, so forgive me for that.
No.
Let's start at the very, very top.
Yep.
So we've got, and we're going to, maybe we'll come up with an avatar that we're going to be talking about, right?
Yeah.
So let's talk about somebody who's a high income earner, right? An accredited investor, just for the sake of using a relevant term, an accredited investor who has a day job, right? They don't have anything to do with real estate. They don't own real estate. They don't invest in real estate or some stocks and bonds, but they have a day job. At a high level, why should they be considering investing in real estate, either actively or passively? Let's start with passively, let's say in a syndication. What are the benefits to them of that?
Yeah, absolutely. So it's hard to just name a few because there's so many benefits to the real estate space. I think one is that it is a hedge against inflation. So this is not necessarily a tax topic, but I often say that there's 4 things your real estate portfolio should have. 1 is cash flow, 2 is appreciation, 3 is leverage, and 4 is tax benefits. So I think if you are operating a real estate portfolio and you don't have one of those 4 opportunities or attributes, then your portfolio is actually losing you money. It's not operating at its full potential. And so those are really the 4 places that a high net worth individual can see the benefit of real estate. So if we talk about inflation hedge, it's this idea of leverage, right? It's a physical asset that only goes up in value, and when you're combating inflation, which we have experienced a large inflationary state, you need something that is going to increase in value at a greater level than the value of the dollar. And that's what real estate tends to do, because there's only a limited supply to the amount of real estate that you can have on this God-created earth. And so that is one is inflation, hedge against inflation, but I also will focus today on tax benefits. So
yes, let's definitely do that.
We all love to, making money is a good thing, and we need to do it to provide for our families, to support our society. And we've often been told that you also have to pay taxes, right? Death and taxes are the 2 guarantees in life. And I think we have focused too much on this need, like you have to pay taxes, and haven't focused enough on the beauty that the tax code can offer in the form of tax savings. And a lot of that is done through the power of real estate. So one thing that is clear to me is that real estate investors, and when you offer yourself up as a syndicator and put money into a syndicate, you aren't just putting money into a fund that's going to go invest in real estate. You're putting money in a fund that is going to provide housing to a group of people, especially with these big commercial properties, right? You can have upwards of hundreds of thousands of people in any given complex. And so, yes, you're investing in the building, but you're also providing the form of living for people that either don't want to buy their primary residence, they can't afford it, maybe they're living in the States for only a certain amount of time and renting just makes sense, whatever the reason is, but they need housing and you're providing that by investing in it. And so the government says, hey, Adam, you are investing in this property. We're going to give you a benefit because you're supplying our citizens with a place to live. And so they've written these laws that are, some people call them loopholes, or some people call them cheat codes, or whatever it is. But it's the law. It's incentivized by Uncle Sam and the politicians down in DC to go and invest in real estate, and in return you get a tax benefit which can decrease the amount that you pay the government, because then they also say, okay, we see that you do this once, we're going to give you money back so that you can go and do it again, thinking that the more you do it, the more housing their citizens get and the more incentive that they're able to give to you.
Okay, so let's drill down on that, and I'm going to confess to not being quite as ignorant as I did suggest that I might be.
Right.
We've got this avatar, and
Yep.
he has earned income.
Yep.
Right, so he's earning income. It's not passive. This is he's putting work into it.
Right.
When you invest in a syndication, what you are getting is passive income.
Yep.
We can talk about the real estate professional status later. All right, so that's something a little bit different. But I've got earned income, and I'm going to be earning passive income, short term, and then capital gain, long term capital gain.
Yep.
If an asset is sold at some point.
Right.
So I've got this income. Let's call it 200,000 a year, right? Which is the minimum threshold. How does investing in a real estate syndication help offset that income? If it does, how does it work? Let's get into the nuts and bolts, and don't be afraid to dive deep. If you say anything that I don't understand, don't worry, I'll let you know.
Yeah, please do. Because I get fired up about this. It's hard to believe that people can get fired up about the tax code, but I think it's pretty cool, and I understand there's a need for people that need to be instructed on it. So sometimes I can get into the jargon and it doesn't make too much sense. So yeah, please stop me if that's the case.
Yes, don't be afraid. We've got look.
Yeah.
Here's one thing: accredited investors, right, which is
Right.
largely our audience over here.
Yeah.
Have professional qualifications. They might not be experts or advanced degrees. They might not be experts in real estate, but
they're smart.
They're bright people. Yes.
Yep. Yes.
So
yeah.
Don't be afraid to dive deep, and trust me, I will interrupt, or I will come in late and say, what the heck are you talking about? Don't worry.
Absolutely. Yeah. So to answer your question, if somebody's making $200,000 and they're investing in real estate, it actually is challenging to get the full benefit, right? Because your $200,000 is usually in a W-2, and it's something that you're working 40 to 50 hours a week, maybe more, to earn. And so the IRS classifies that as active income. And so in order to have active income be decreased, you need to offset it with an active loss. And back in like the 1980s, I think it was, there were a lot of people that were accredited investors, lawyers, doctors, people making $200,000 and more. And then they were using real estate to offset it all and not pay any taxes, which was awesome. Like if I lived in that time, I would have loved it. But you can imagine that Uncle Sam and his helpers down in DC didn't love it, because they weren't getting any money from these high income earners who they considered to be where more money should be made, right? If they're making a lot of money, they should pay a lot in taxes. And so the IRS, the US government, Congress, the Senate, they said enough of that. They had a big tax overhaul, and now all real estate losses are going to be passive in nature. And so that basically means that your W-2 income cannot be offset by your passive losses that you get in real estate. So there's a few options, right? It might seem like a lost hope, but you mentioned one, Adam, in the real estate professional status. Yes, that's great. And we can get into that. Obviously, there's some restrictions there, is that you have to be a real estate professional and dedicate a certain number of hours to your real estate duties, which is hard when you're in the W-2 because the IRS will come at you.
That's a whole different issue. Let's definitely drive into that. I've been reading extensively about that. So
it's tough.
But we are talking about somebody who has a real job.
Right.
And well, let's go, we don't have to say 200,000. It's not, 500,000, whatever. They've got some savings, they've got some investments in stocks and bonds, and they can't offset, but they can offset their passive income. So let's say they invest in a syndication that's paying an 8% return, for argument's sake, right? Paying an 8% pref. And for argument's sake, they get a sale, right? They've got a sale at the end of the day, and that doubles their money, just for argument's sake. And all of that is passive, right? The capital gain and the income. Correct me at any point if I'm not right.
Nope, you got it.
If this is how you use depreciation, isn't it? To offset both the preferred return, that passive income that comes every month or every quarter, plus the capital gain. Is that correct? So your depreciation can offset the capital gain as well. Can you just explain that a little bit?
Yep. Yeah. So when you sell a property, you are likely, assuming you've held it for a certain amount of time, or you're in a time where the value has gone up, you're going to get a capital gain. And
long-term capital gain is still 1 year, correct?
It's a 12 months, greater than 12 months. So anything less than that is a short term and taxed as ordinary income. And so we see a lot of flippers that get into hot water because they're making serious profit. But that's a whole nother topic. So long-term capital gains rates are typically anywhere from 0 to 20%. That 0% is very low, and chances are you're not going to be in that. So then you're either at 15 or 20%. But the thing is, you can very easily get into that 0% by using the things that you're talking about in the form of depreciation and accelerated depreciation and cost segregation, having that be passed down to you as a passive investor. You can then use it to offset some of those capital gains, and then you're able to exit your property and get the cash here and not pay any taxes on it. So you're spot on.
Let's peel that onion a little bit. It's a good topic.
Yeah.
So here we've been earning, let's just call it our avatar here, our investor's been earning 8% per year.
Yep.
In preferred returns that have been paid to him. That's passive income that he's been getting.
Yes.
And so that's taxed as at the income rate. It's income. That's income tax, right? Not capital gains. Then the property is sold. So he's going to get a big lump sum. He invested 100,000, gets another check, gets his 100 back and another 100, just for argument's sake.
Yeah.
Now, how does the depreciation work? He could actually invest in another deal in parallel that gives him depreciation benefits. What is depreciation? Let's just talk about that to start with. And how does it offset the tax liability on, let's call it investment A, the 8% and the doubling of his money, but he invests in something else to offset, in deal B to offset deal A. So how does all that work?
Yeah, absolutely. So depreciation is, I like to call it's this phantom expense, right? It's this expense that just kind of shows up out of nowhere. You didn't have to pay any money for it, but it's on your tax return, and it works wonders because it often gets you these losses that we're talking about, right? Those losses that these lawyers and these doctors were using to offset their active income. The way they're able to do that is through the beauty of depreciation. So it varies from asset to asset, right? A car isn't depreciated in the same manner that a house or a commercial building is. And so the IRS has given us depreciation tables and depreciation useful lives for us to be able to calculate how much you're going to get on any given year. So on a commercial property, it's usually 39 years. Some of these residential properties are 27 and a half years, but you basically take the purchase price, take out any land, and divide it by whatever the useful life is, whether that's 39, 27 and a half, 5 years, and you get your depreciation expense.
Right. So let me just drill down. I'm going to just put it
Yep.
into 101 language for
Yes, please.
idiots like me. So when you say that, what you mean is, so I'm taking the value, subtracting land because you can't depreciate land,
Yep.
dividing it by 39 or 27 and a half, whatever
Yep.
those two numbers are. And
Hmm.
what you end up with is you are going to get at the beginning of the year, for the prior year, you're going to get a K1
Hmm.
that says you suffered a loss,
Yes.
right? And that is, you can use that loss. Let's say it's $10,000, right? You get a
Hmm.
K1, which is the
Yep.
correct form, right? That your whoever you invested with is going to give to you. That
Right.
says you suffered a loss of 10,000. So that's on our deal B. I got this loss, but on deal A, I earned 10,000.
Hmm.
That's where I can um cancel them out, right? That
Yes.
10,000 a loss goes against the 10,000 of income. I don't pay income tax on that, correct?
Exactly. You're spot on.
Bonus depreciation. So how do
Yes.
we accelerate that? Because this is where it gets really interesting. 39 years, there's not much depreciation, not much loss that you're going to be taking away, especially if you've got a capital gain that's doubling the value of an investment. So
Yes.
what's bonus depreciation, accelerated depreciation, cost segregation, kind of thing Yona Weiss lives and breathes.
Yes.
Talk
Yeah.
about that. How does that help us?
It is one of the beauties. Like I said, this tax code can actually be beautiful if you try to understand it and get into the details, which it's not. I don't recommend. I don't recommend you get into the details. I recommend you hire a qualified tax
Rely on
professional
somebody
to
who
do it
thinks
for you.
it's a beautiful thing.
Yeah, exactly. 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 So as far as cost segregation goes, so yeah, you're talking $10,000 of a depreciation deduction. You can offset $10,000 of income, but we're looking to
Passive
do more
income.
than
Let's
that.
be clear, only of passive income.
Yes,
You can
passive
only
income.
offset
Exactly.
passive income.
Exactly. Yes. So then, but in our example, we said that you had $100,000 of capital gain. So you take $10,000, you offset 10 of the 100, you're still dealing with $90,000, which is going to be taxed, and we don't like to pay taxes, right? So what we can look at is this idea of cost segregation or accelerated depreciation. And what cost segregation will do is it'll take your 39-year asset and it will point out, okay, you have lights in there, you have air conditioning units, you have carpeting, you have flooring, you have all these different things that make up this one commercial building, and it'll break it out into their different useful lives. It will segregate it by useful life. So you have a 5-year useful life, you have a 7-year useful life, you have a 15 and a 27 and a 39-year useful life. And so these experts, these engineers will go in and determine how much of each property is a 5-year useful life, how much is a 7-year useful life, how much is a 39-year useful life. And that way you're able to, again, accelerate, because what was once all bundled up into 39 years is now broken off into 5 years. And so that $500,000 worth of 5-year property is accelerated compared to the 39-year, and that
So
gives you a greater
let's
depreciation.
put that into specific examples. So now I've got this $100,000 gain,
Yep.
and in deal A, in deal B, they do a cost seg study,
Yep.
and they they are able to compress the depreciation into 5 years, not into 39 years.
Yep.
So that means that might be a $500,000 depreciation. That would be $100,000 per year of those
Yep.
5 years. If that passes through to me, that means I can eliminate entirely the capital gain or the tax liability on that capital gain, correct?
Yep. You got it.
Right. Now, and how does this work in a syndication? If I'm a so I so a syndication, I know what syndication, I'm just again just dumbing it down just for my sake.
Yeah.
But if I invest in a syndication, I am investing as a limited partner in an LLC or a limited partnership or some kind of entity.
Yep.
I get a pro rata share of any distributions. Do I also get a pro rata share of depreciation? Does that pass straight through to me?
Yeah, so that's a great question, and it does depend on the type of syndication. So you're going to want to make sure that you're clear with the person who's organizing it and the tax advisor behind it to make sure that all of the expenses, including the depreciation expense, get passed on to even the limited partners. Because there's some syndications that are only the general partners will get the share, and that's both on the tax loss side as well as the tax gain side. But there's other syndications where everybody who's invested gets the benefit of the depreciation. And I don't know, I can't remember exactly what the difference is or what the two specifics are. If people want to know, then we can talk about it. They can reach out to us.
Yeah, I was going to ask,
them,
is there anything in particular to look for? This is something you should actually ask the syndicator. There's nothing you can. Okay.
Yep, exactly. Yeah.
So it will be something that's embedded in the offering documents, presumably, right?
Yes. Yep. 100%. And this is, most syndications, most people that I work with who are invested in syndications were able to get the full depreciation benefit. So
and it passes through pro rata.
Yep. Yeah. Like on you invest 100,000 and that makes up a portion of the investment. You're going to get a portion of the depreciation.
Same portion of depreciation.
Yep.
All right. So what is bonus and accelerated depreciation? Are these both cost seg things? And there was something that really drew my attention last year, and that was something about bonus depreciation going from 100% and then to 80 this year, or it was 80 and now it's going to 60? Like, what's all that about? Bonus and accelerate.
Yeah. I'm so glad you're asking these questions, because we see these on you're on LinkedIn or Facebook or Instagram, and you see, okay, bonus depreciation is decreasing, and you say, what the heck does that mean? I don't even have an idea. Which is why we're here.
It's the mission we're on.
Yes. So we talked about the tax overhaul of 1980. There's constantly tax changes, but the most recent one was in 2017. President Donald Trump made a large tax overhaul that included things like this idea of 100% bonus depreciation. So from the years 2017 up until the end of 2022, you could not only get cost segregation, but you could also get a bonus depreciation, which would be some qualifying assets, typically 5-year assets, you're breaking it out on a 5-year spectrum. But now not only are you going to divide it out over 5 years, but what bonus depreciation does is says in that year that you've put this into practice, we're going to allow you to fully expense it 100% of the deduction. So we go back.
What kind of assets? When you talk about qualifying assets, just give me some examples. So specific.
Yeah. So a lot of these are like appliances. There's a difference between, if you want the technicality, it's section 1245 or section 1250 assets. One is a qualified bonus depreciation asset, one is not. And so it's typically those that are 5 years or less are bonus depreciation. Like we see it a lot in cars. You might go on Instagram or TikTok and somebody's like, you can deduct all of your car for the year 2022. And it's correct to a certain level, but
you can only deduct your car if you actually use it for business.
Right.
And you have to document your use for business, correct?
Yes. Yep. And you have to do this bonus depreciation, but bonus depreciation on vehicles doesn't work the same as bonus depreciation on assets like real estate assets, or more specifically the 5-year assets.
So let's stick with real estate. We can go down so many rabbit holes.
Yeah, you could. So we have this $500,000 5-year useful life. I just, for simplicity's sake, let's just assume it all qualifies for bonus depreciation. Mm-hmm. You can now take all of that $500,000, expense it. So rather than having $100,000, you have now increased that to $500,000, and that loss translates to all of the investors that are able to
right.
Get
so those are losses. Let's just drill down on that a bit. So we've got our investor made $100,000 of capital gain, plus his 8% that he's been earning, right? So let's call it 108,000 for 2022. But he invested in something that gave him a $500,000 depreciation benefit. That means that for 2022, last year, he could only deduct He'd only benefit 100, let's call it 100,000 of that $500,000 loss, that depreciation, that accelerated depreciation loss, but he can carry it forwards, can't he? What does that mean?
Yep. Yeah. So two things. I do want to clear up that because you mentioned it and I didn't really address it. So bonus depreciation up till 2022 was 100%.
Right.
Tax year 2023, they decreased it to 80%. Tax year 2024, it decreased again to 60%, and that's going to continue on until it's completely phased out until tax year, I think tax year 2026 is the last year, and then 2027 it's not available,
That's
assuming they don't
just
make any changes.
accelerated depreciation, right?
Yeah. So you can still benefit from cost segregation, but you won't get the added benefit of bonus depreciation as the tax code stands right now. There's talks of it. They're going to look to extend it and maybe even keep it as a permanent tax benefit. So that's why tax professionals are constantly looking at changes down in Congress. But right now it's 60% for 2024. For 2023, it was 80%. As far as the deduction, the passive losses that you'll carry forward. So yes, in our example, we had $500,000 of a loss. You had $100,000 of a capital gain. That means you have $400,000 of losses that are now carried forward. And so you can use that in future years to offset any passive income. So chances are the syndication that you invested in won't show as much of a loss in this next year because you used a big chunk of the depreciation. So we can now use it against some of the income you get from there. And maybe you want to go into private money lending and you want to give somebody $100,000 to do a quick flip, and then they're going to pay you interest. Now that interest is income to you, but it's passive. And so you can use the 400,000 to offset that interest.
Well, or you can also invest in another syndication.
Yep. Yeah.
And how far forwards can you carry it, Chris?
So these carry forwards, as far as real estate losses go, these carry forwards are carried until they're used up completely. So it's sometimes there's some losses that are only carried forward till 20 years, but here in real estate with these passive losses, you can carry forward until you use them. So we see people that have, and this is the thing, is like, this is why tracking is so important and working with qualified CPAs and tax professionals who know what they're doing. Because if you miss 1 year, if you forget to put it on your tax return as like, this is a carry forward, well, that's the next year it's going to be missed and you just lost it all. So
you can't submit what do you call it?
You can amend it. You can amend it. Yep, you can amend it, but it takes a keen eye, and that's why when we work with our prospects or our clients, we want to look back at least 2 years of tax returns to make sure that everything's working properly and the left hand knows what the right hand's doing.
Let's add another layer.
Yeah.
All right. So now our investor avatar owns a rental property. Let's say he inherited or bought a duplex or a fourplex or something, right? But he's sick of dealing with it.
Right.
But his basis in that is very low. And if he sells it, he's going to make a huge profit that would be subject to long-term capital gains tax. He can do a 1031 exchange, can't he? What is a 1031 exchange?
Yeah, 1031 exchange is another great gift of the tax code. It basically says if you have a capital gain on a certain type of property, so we'll use real estate, for example, you can then take the proceeds from that sale and invest it in an asset of a like kind. So you take a real estate property, a duplex that has a large capital gain on it. You can now, instead of paying that capital gains tax, you can now take those funds and invest it in a property of equal or greater value. So again, it's usually requiring you to take a duplex and go up to a fourplex, or take a duplex and enter into a syndication.
Right.
But it's an asset that is of like kind and of equal or greater value, and you can defer. So now those capital gains tax is deferred. It's not completely avoided, it's deferred, but you can do this unlimited amount of time. So if you have a duplex, you don't want to pay the capital gains, you upgrade to a fourplex, you want to get rid of it, don't want to pay the capital gains, buy another fourplex, so on and so forth. You can keep doing this until you die, and then when you die, you get a step up in basis. So the people who inherit the property now are able to inherit that property without paying the capital gains tax that's been deferred all these years.
Fascinating. Gosh, that's interesting, isn't
Yeah.
it? So now we've got this. So now we've got our avatar,
Yep.
and he's got these deals, right? We talked about deal A and deal B, but he's also got, let's call it a duplex. And he sells it, or he wants to sell it. He's going to make $1 million of profit, right? Capital taxable, capital gains taxable profit. So he can, even though he owned the fee simple for that asset, he can take those profits and he can invest that in a syndication.
Yep.
He could do a 1031 into that syndication. So now he's got $1 million investment in that syndication, which means that he's also going to get depreciation, isn't he? He's going to get big depreciation off that, potentially.
Yes. Yep, potentially. And I do want to say one thing for the 1031. There's specific guidelines. So timing, you have to have it. It all has to take place. Like the next asset has to be bought within 180 days. So it could be that syndications aren't the best move if it's like we're going to pool your money, and until there's an asset on the market, then we're kind of just holding on to it, because you do
I
have
think it's 45 days to identify, isn't it? Something like 45 days to identify, 180 days to close. But that aside, just looking at the tax, I mean, there's a lot of, and we could talk about reps again in a minute. So we're going to run out of time. Unfortunately, so much.
Might have to do a second one. Might have to do
well, I'm happy to do that. But just drilling down on this. So he sells this thing, he invests it in a 1031s into a syndication, not a fund. So he's going to invest in 100 unit, sells a 2plex, and he's going to buy a share of 100plex. So the 100 unit apartment building with a sponsor.
Right.
And that sponsor can then pass through depreciation. It would be significant depreciation he would get then. From that, relative to investing just 25,000. So it's highly beneficial for him, would you say, to do a 1031 exchange?
Yeah, I always recommend 1031s, but if you don't want to do a 1031, then you can, there's ways you can use cost segregation to avoid the capital gains. But I think 1031 is one of the best. People are like, oh, everybody knows about a 1031. What's the use? But it's like,
well, cost seg expire. I mean, that has a useful life, doesn't it? I mean, if this guy's owned it, say, for 10, 20 years, he's not going to get any more depreciation out of it, is he? Right.
So I'm saying in the use of cost seg. So sometimes people are a little hung up on the deadlines for 1031. They're like, I don't know so say you sell the property right now, January 2024, and you're not sure you want to get a new property in 180 days. You would rather wait, and then you want to buy a property in, say, December of 2024. So what you can do now is until you buy that property, you're on the hook for capital gains tax. But what you can do is buy a new property and then cost seg that property, so that the capital gains that you would be paying are now being offset through the use of cost segregation and depreciation. So whether it's a 1031, whether it's a sale and then using cost segregation, the idea is that when you sell these assets, you're going to be on the hook for capital gains tax. And so before you sell, you should be meticulously planning, okay, do I want to do a 1031? Do I want to wait a little bit and then invest in a property and do cost segregation on that property? And all of this is done through proper planning and just an understanding of the tax code, which is what you're doing here, Adam, is educating yourself and many others about the benefits of real estate.
So I got two more questions for you, actually. Three. I want to know how we got to find out how people can reach you. So learn more. But two questions specifically, and then we do have to wrap up, unfortunately, because I wish I'd got more time with you today. But one is, these are big questions. Okay, so real estate. There's all kinds of real estate, industrial, residential, industrial. We'll talk commercial real estate, but industrial, medical office buildings, self-storage, data centers, right?
Yeah.
There's a whole range of it. Are any particularly friendly for cost segs different? If you were to put them all on a scale, which would be the one that would give you the best depreciation benefits?
Yeah, that's a good question. So I think from highest to lowest, highest being the best benefit, it's like medical buildings and data centers, places with like a ton of assets, right? So medical buildings, you get these, consider a dentist office, right? You get the dentist chair, you get all the equipment that's in it. That's all going to have a useful life that's smaller than the actual building itself. So cost segregation is going to come with the greatest benefit there. Data centers, assuming you're getting like the technology with it, like you're going to get, yeah, again, some good useful life assets included in that transaction. The warehouses and places that don't really come, it's just kind of open space. I'm not saying that there's no benefit, but it's going to come with less benefit as you would with some of these things that have more intricate assets in it. So I'd say medical and then data centers and then the warehouses. Commercial buildings are great because you get a lot of different units that have their own appliances and stuff like that. So
Multifamily is good as well, isn't it?
yeah. Multifamily is great. It really comes down to what are you buying in the actual asset itself? Is it coming with furniture even? Like, because if it's coming with furniture, a traditional tax preparer will see it and say, okay, this is all built into this $1 million purchase price. But somebody who's doing cost segregation will say, well, wait a minute, there's beds and couches and appliances that all have useful lives of much less than 39 years. And so, yeah, the ones
Hotels,
with more
do
assets.
hotels depreciate fast as well?
Hotels will depreciate at the 39 year because it's a commercial one. But if you're taking into consideration the bedding and the
Yes.
showers, yeah, you'll have a great benefit with the cost segregation.
Okay. And then my last question, other kinds, so we talked about real estate, but what about
Yeah.
other kinds of assets? For example, there's one that's high on my radar at the moment. It's kind of an interesting one, is one of our clients actually does a lot of work in ATMs, for example, or car washes, for example. Are these that, they're not really real estate, but they are things that individual investors can invest in. Are there other alternative investments that offer particularly good depreciation benefits in the same way?
Yeah, definitely. So as far as car washes go, those are great because you get all the material that is involved in a car wash. And so while the building itself might depreciate at 27 and a half or 39 years, the machines that actually clean the car are 5-year useful life. So you can get some benefit on the cost segregation. I'm not too familiar with ATMs. I do have one client who does it. And I know that there's some benefit to it, but I haven't studied it enough to say what that benefit is. But I'm sure I can get more information, and if people reach out to me, then we can talk about that. But then I would also add, especially for the high income earners, one thing that is often overlooked is the oil and gas industry. So oil and gas in year one that you invest is far more likely to develop a loss. And the difference between the loss that you get on oil and gas and the loss that you get on real estate is the oil and gas will be completely active. So with this tax code, they say that those losses that you generate in oil and gas investments, qualified oil and gas investments, are going to be active losses against your active income. And so we had one of our high income earners use this past year, and it probably saved him about $25,000 to $50,000 in taxes. So oil and gas is a great industry. There's a little more risk there. So I do want to make clear that, but yeah, that's another place that's often overlooked or not really talked about.
And that's active. That comes off active income.
Yep, in year one. Yep, yeah. In year one, so it comes off active, but year one's the year that you're going to get a loss because they're putting all this money into the equipment that's drilling down and getting.
And that's not passive. Those aren't passive losses. Just to be clear.
Yeah. So oil and gas has the unique loophole of being an active loss to offset your high income.
Well, so that's the perfect segue into my last question before we about how folk can get a hold of you.
Right.
The real estate professional status.
Hmm.
This is, I read a whole book on this last night.
Wow.
Not easy to get,
No. No.
actually. But
Yep.
the principle here is that if you have real estate professional status, um, you you your passive losses can be used to offset active income. That's the
Yep.
point. You're turning your passive that's basically the distinction, is it? Just talk about that. It seems to be thrown around a lot. People
Yeah.
talk about it as being something really easy. Clearly is not.
Yeah.
And you know, you can't mess about with the tax code. So
No.
just give me a high level. What is the REPS real estate professional status? How do you get it?
Yeah. Yep. So real estate professional status says if you're a full-time real estate professional, so think people who are spending, that there's guidelines. So people who are spending, it's more than 750 hours in a real estate trade or business. So you're thinking like real estate agents, some of these investors, people that are managing portfolios, managing properties, you can qualify for real estate professional status, which basically says any income or loss that you have in that real estate trade is active. So if you're a real estate agent and you're making $250,000 in your sales, then you also invest in properties which have losses. Traditionally, those losses, as we've discussed, would be passive. But because you're a real estate professional, real estate agent working full-time in the real estate field, you can use those losses. Now, there's a lot of compliance that needs to be done in the form of grouping and making sure that everything is treated as one activity. So you're going to want to make sure that you have sign off by a qualified tax professional, not to mention that this is one of the most audited pieces of taxes, because the IRS is aware that this exists, and they know that people abuse it and don't fully understand it. So I would, before you go claiming real estate professional or telling people that you're a real estate professional, meet with your tax advisor, make sure you check all the boxes. But yeah, it's a great benefit.
Really not easy. It would be nice to think that investing in spending a lot of your money investing in syndications would make you an REPS real estate professional, but it doesn't. You've actually got to this is one case where you really do have to unclog toilets and fix drains, right? I mean, that's basically what it means. You are hands-on, actively engaged in the project. Chris, what a pleasure meeting you. Thank you so much for joining.
It's my joy, Adam. This was awesome. I'm excited.
All right. So how does someone get in touch with you? What's the best way, and how would you like people to reach out to you?
Yeah. So Adam, I believe, reached out to me on LinkedIn. Maybe you even got into my email, but yeah, email is chris@betterbookaccounting.co, and I keep track of that, and we'd love to get to meet you, see if we have a good fit for what you're looking for. But other than that, you can find me on LinkedIn, Chris McCormack, CPA, MBA, CTP. That's CTP is Certified Tax Planner. And yeah, I would suggest if you're investing in real estate, if you're doing these syndications, you're going to want to find a real estate tax professional who focuses on tax planning, so we can talk about these things on an annual basis. Yeah, email, LinkedIn, Facebook, Chris McCormack, and then Instagram is Chris McCormack CPA.
Chris, yeah, real pleasure meeting you. Thanks so much for joining me today. And let's stay in touch.
Absolutely, Adam. I'm excited. Thank you for having me, and thank you for educating your people. This is great.
That was Chris McCormack, who is a CPA at Better Books Accounting, talking about some of the high-level benefits and intricacies of the tax code affords to both sponsors and investors when they invest in commercial real estate. If you want to know more about Chris, go to the podcast page at gowercrowd.com. And while you're there, as I mentioned at the beginning of this show, do please subscribe to our newsletter. It's totally free. Goes out once a week, and you can always unsubscribe. Chris, what a pleasure meeting you. Thank you so much for joining me today. I look forward to staying in touch. And thank you to dear viewers. If you've got any questions that you would like to pose both to me, or either to me or to Chris, do feel free to sign up to my newsletter. As soon as you get the first email, you can just hit reply. It'll come straight to me, and go to the podcast page to find out how to, at gowercrowd.com, to find out how to contact Chris directly as well. Okay, that's it for this week's episode. Thanks for joining me. I will see you next time. And until then, this is Adam Gower signing off.